What's going on, guys? Welcome back to the channel. So today we're going to answer a question on the backdoor Roth IRA, avoiding the pro rata rule, and a little tax timing. So here we go. Here's the question. Hi, I can't seem to find the answer anywhere on this, so thank you for reading. Can I roll over money from my IRA into my current employer's 401k and then add $6,000 into the IRA for a Roth conversion in the same year? My confusion is if the pro rata rule will count up what I had in my IRA historically for this year and not what I had in it before I did the conversion. So to clarify with an example, say that in March 2023, I roll my IRA into my 401k. Then I add $6,000 into my now empty IRA in April 2023, and then I take that $6,000 and move it into a Roth IRA in May 2023. I won't have to pay taxes on what was once in the IRA earlier in the year, ? Before I rolled my IRA into my current 401k. So that is a good question. Let's go ahead and walk through it. I'll draw it up here on my whiteboard, and I'll also add a couple other things just so you can help really understand the backdoor Roth, avoiding the pro rata rule, and these taxes. So let's tackle this example. So the first part says, in March of 2023, I rolled my IRA into my 401k. So let's just throw a number on there, $25,000. It doesn't matter, whatever it was. So let's take this $25,000 IRA, which was once an old employer 401k or employer plan, and we're going to go ahead and roll it into our current 401k. Now, what you need to know here is your 401k just needs to be able to accept the dollars from your IRA. And if there are non-deductible contributions in this IRA, they just can't go into the 401k, but that's okay. It's actually what you want to have happen anyways. So it's not necessarily cherry picking. You just have to leave those dollars behind. Now, the second part is I then added $6,000 into the now empty IRA in April of 2023. So let's throw some dates on here. Let's put 2023, and we'll put that over here. So that rollover is a non-taxable event, perfectly fine. And we did that in 2023. And then we're going to go ahead and add $6,000 into our IRA in 2023. Now, for this contribution, it could have been one of two things. It's likely it was a non-deductible contribution. That is a non-deductible contribution into your traditional IRA, not a non-deductible IRA. There's no such thing. It's the contribution. It could have been pre-tax. That's possible, but you'd have to be below the income limits because there's a workplace plan or an active workplace plan. If there wasn't a workplace plan, then you could do at any income level the contribution into your IRA as a pre-tax contribution. But we're going to assume that is a non-deductible contribution in 2023, but it could have been for 2022. So that's what we're going to assume, that it was a non-deductible contribution for 2022 made in 2023. Now, what we're going to do from there is we're going to take that $6,000 that's in the IRA and we're going to roll it into the Roth IRA. We'll put that over here. Now, this was done in 2023, and unlike a contribution, it cannot be retroactive. So if you did the conversion in 2023, it counts for 2023. That is really important because even though the backdoor strategy is two transactions in this case, it's a non-deductible contribution and then a Roth conversion, it is two separate transactions. So this transaction down here, you could do it retroactively if you want to, but a conversion you cannot. So you can make this contribution up until your April filing deadline. And whenever you do that conversion, that is the tax year that it's going to count for. So the last part of this question is asking, I won't have to pay any tax on what was once the IRA earlier in the year. So no, you're not going to pay double tax because this is an after-tax contribution. And this gets tracked on your Form 8606. And when you're doing that, you're making that non-deductible contribution and then you're bringing it over to your Roth IRA. This amount that is in the IRA matters on 12/31 of the year that you do the conversion. So we actually don't know if there's going to be a pro rata rule here, but if we know that in advance, we can avoid it by making sure that on 1231, there is no pre-tax money inside of this IRA or any IRA that is in your name. And in your name, so if you're married filing jointly, your spouse's IRAs are not included. It's just your IRA. So if you have 17 different IRAs, 50 different IRAs at 10 different institutions, it doesn't matter. You have to add them all up as look at them as one big IRA, including your SEPs, including your simple IRAs. You add them all up, and that is the ratio of pre-tax and post-tax dollars, and that would affect whether or not you're going to be taxed for that conversion. Because if you do have pre-tax money in here, then unless you do the conversion of the entire amount, then not all of that converted money, not all of those converted dollars are going to be just non-deductible contributions. In this instance, you cannot cherry pick. You cannot choose which dollars get converted or which dollars do not get converted. It is a pro rata rule. That is what you would be subject to. So that is how that works. So one strategy, but two separate transactions, and that matters on 1231 for the pro rata rule. And that is likely why you would want to roll it up to a workplace plan. However, I don't make the recommendation to do that because I like to have control of the investments, and I can do that more inside of an IRA and less inside of the 401k. Not that the investments are bad in the 401k. That's just a preference that I usually go with because I like that control. And then you also have to be aware that let's say that you change jobs again in 6 months from now before the end of the year, and then you rolled it all the way back. Again, pro rata rule there. So a little bit of something they have to be aware of when you're doing this stuff. Now, let's say I change jobs. I don't know, maybe I would leave the money in the 401k until after 1231 to avoid the pro rata rule and then bring it back into the IRA if that was the case. So there's a lot of different ways to look at this. And that's probably why I do so many videos on this, because I get questions that are just a little different each and every single time. So if you have questions on this stuff, let me know in the comments down below. And also check out our Discord server. You can ask more questions there. We can give you a little bit more detailed answers, a little bit more space to type out there. So go ahead and check that out. Link in the description at the bottom. If you've enjoyed this video, be sure to subscribe, and we'll see you on the next one.